So, I mean, while we're waiting, selfishly, I'd love to hear about how you guys are experiencing things in the market right now, because you're first and foremost mortgage broker. So are you noticing an uptick in terms of like applications and stuff like that?
Yeah, it started like almost September 1st. We went back to like January, February was our busiest months for leads. And then it just died. And then September, it just came right back. September and October were our busiest months. November was decent. So yeah, people are.
Any predictions for interest rates, December
I'll,
11th?
I'll let Dev talk about that.
Yeah, look, buyer confidence is going to return as rates continue to come down. Right now, we're 50-50 on a 25 or a 50 beeps cut come next week. Honestly, it hinges on our employment data coming out on Friday.
Okay.
Our employment data typically goes through some types of revisions. And if we really dig into it, like most of Canada's hiring right now is in the public space, so the government, right? Or hiring rather than private industry, which is never a really good reflection of how our economy is doing.
Right.
So it wouldn't surprise me to see the Bank of Canada go a little bit more aggressive on the cuts, because some of the data may be a little bit reflective of a stronger economy than we're actually experiencing.
Yeah.
I think, the banks are so varied on where they see the terminal rate for policy. Scotia's not overly competitive, or not competitive, overly aggressive, I guess, on where they see that terminal rate be. But then you've got, CIBC, RBC really expecting the Bank of Canada to have to come down further. So I think we're going to see an interesting shift. Variable rates have been so high for so long, much more expensive than your fixed rates. I think we're going to see that normalization. Variables continue to fall, fixed kind of stay where we are into next year, and we'll see how our economy holds up. Like, honestly, it hinges on that.
Great. Well, there you have it. A little bit of mortgage expert insight from you two. Appreciate it. I think we're going to jump in. For those of you who have joined us, we're going to record this. So, we'd love for you to stick around. We're going to take some questions at the end of this. And I think I think everyone's going to get value out of this. This is a really, really interesting discussion and topic. But stick around and we'll answer any questions you might have. Also, Sean and Devon have been nice enough to give us free access to their course. They're providing a course where everyone can sign up for it after this. It is free, right? I want to make sure. Okay, good. So they've got this great course that kind of outlines everything. But, I'm really excited to have you guys here. At Connect, everything I do for my clients are things that I've really tried to figure out on my own. And as a very active real estate investor, I'm always trying to figure out where I should be putting my money, but also how I can make more of it and how I can keep more of it in my pocket. And I think there's probably been no better time to really start thinking about tax strategies and strategies to keep more wealth in your pocket. I mean, capital gains has recently increased. Corporate taxes and personal and corporate taxes are very high. So I think it's really important for real estate investors to not only think about real estate investing as the strategy, but also other strategies to help you keep and make more money. And, I've gone through the course. I found it incredibly informative. In fact, I think you guys are probably going to save me millions of dollars over the next 20 years, which is really exciting for me and my clients, probably hundreds of thousands, if not millions of dollars. So really, really cool stuff. And for those of you tuning in, I just want to make it clear that this might sound complicated. It's actually quite an easy concept. I think for you being able to execute on it and put it into place, it could be complicated, but that's why we have experts. And this is why I love having guests on like you two, because people shouldn't have to figure this out on their own. It's really important to partner and team with people who have been able to achieve what people want to achieve. And that's why I think a lot of our clients love working with me and my team. So really excited to have you guys here. This is your presentation. I'll let you guys jump in. I may jump in with a few questions because I'm so excited about this topic. I'll try to wait until the end, but we'll see.
Okay, perfect. So Devon and I, we're both mortgage brokers. I've been doing this for over 13 years, Devon, I think close to 7. We can do your average mortgages, self-employed, net worth, all that good stuff. But what we really specialize with is these more advanced strategies. And one of the reasons we do that is just what Ryan said, kind of the economic landscape we're in. Everyone's got their hands in your pockets. So if you can find ways to pay less income tax, pay less mortgage interest, and then leverage other strategies on top of that to build wealth, that's where we think we can have the biggest impact.
Yeah. So thanks, and thanks, Ryan, for having us. Are we sharing slides yet?
Yeah, so we'll share slides in a second. Keep in mind, you don't need to take notes. At the end, you'll have access to an entire summary document, which will show the movement of the money, frequently asked questions, what it is. So just try to be as engaged as you can. If you can save questions till the end, because I think you're just going to have access to the slides right now. You're not going to be able to see us. And we'll address most of what we can at the end. And we also have a slide where we looked at Ryan's situation.
Great. Excited to see what you came up with.
Awesome. All right. So I'll take it over from here, and we'll dive into what Sean and I are really excited to share with you guys today.
We don't have the presentation. If you're trying to share it, I do not see it.
Okay. All right. We've
so we gotta share that.
Started it. So let's.
Can you see it now?
I do not see it now.
Gotta love technology.
What about now?
No. Do you see it on your computer? So there should be a present button.
Yeah. That's the one button we forgot to click.
Yeah.
All right. There we go.
Great.
All right.
Now we can see?
Great. Yeah.
Awesome. All right. So we'll start from the top. So Sean and I are, very excited to be here to talk through what is our favorite mortgage tax strategy right now. Okay. It's actually the one that the CRA calls rental cash damming. So don't blame us for the name. But cash damming itself is a strategy that complements and really helps us maximize the value that we can drive from investing in real estate. Honestly, to accelerate our path to financial freedom, to building wealth. And it does so by transforming the way we kind of manage our debt. Now, cash damming in and of itself is a strategy that's going to allow us to generate substantial income tax refunds over the lifetime of our mortgages. And because we're generating those income tax refunds, we get to leverage that additional CRA's money to pay down our mortgage debt years ahead of schedule. Now, because we're out of debt years ahead of schedule, we're obviously freeing up a lot of cash flow, providing us with opportunities to invest in any types of other asset classes. And our clients have used this. We've got dozens of clients now with net wealth improvements over $850,000. Ryan, to your point earlier, like these numbers are not small. They are material improvements. And really the net wealth calculation of what we're factoring into that number has nothing to do with the rental property appreciation, with your home's appreciation, or the cash flows that your rental property generate. These are net additional improvements based on what cash damming can do for you. Now, cash damming is really just a fancy name for this mortgage tax strategy. And the mortgage tax strategy, like others similar to it, is a process that converts what we call our bad mortgage debt or a non-tax deductible mortgage debt into this tax deductible investment loan over time. All right, this particular strategy, because it's related to real estate investing, does need a very specific type of mortgage and line of credit product on your home or cottage, wherever you have that bad debt. And it does require a source of rental income. All right, we'll dive a little bit more into the details of those two in a minute. But before that, I'll give just a quick introduction. Sean's echoed that as well. So Sean and I are both mortgage brokers. We've been doing this for about 20 years combined. This is where we live. This is our specialization. We do advanced planning. But personally, we're also implementing a lot of these strategies ourselves. My wife and I, that's the two of us up there. We got married earlier this year. We've just had our little guy. So we're all fighting the same things that everyone else is that's on this presentation today. And that's adjusting to the realities of today's market. It's much harder to build wealth today in Canada than it has been over the last 10 to 15 years. We're dealing with higher interest rates today than we've seen over the last decade. And again, my expectations are that we're not going to see a material drop from where we are. Obviously, with higher costs drives a higher cost of home ownership. And still, for most Canadians, the cost of our home is our highest and biggest purchase we're going to make. Inflation's a nasty one because it's really silent, but you certainly feel it whether you're at the grocery store or just out at a restaurant. It's eating away at our income, and our wages are not keeping up with the cost of living in Canada. And of course, lastly, I am not opposed to paying taxes at all. I think there's a lot of value that we can drive as society is all contributing, but we are some of the highest taxed individuals in the developed world. We have so few tools available to us to help us reduce that. So it's why cash damming and other strategies similar to it are so valuable to us when we're looking to implement them. Now, these strategies, whether it's cash damming or some of you may have heard of other strategies similar to it, like the Smith maneuver, all hinge on one particular concept. We break this concept into kind of two buckets, and that's the idea of good debt or bad debt. Now, the CRA does treat our debt differently depending on why we are borrowing the money. All right, our bucket of bad debt is the debt where the interest is not tax deductible. This is most commonly the mortgage on our primary residence. If we're buying a boat because we want a toy, if we've got credit card debt, that's typically not tax deductible. All right. Good debt, on the other hand, though, is when we're borrowing money to invest. All right. Now, there are some considerations with this. Typically, when you're borrowing money to invest, it has to be in a qualified, or you have to be investing in a qualified asset with the general expectation to generate income. It's why real estate investment is such a fantastic avenue. And it's why more often than not, when we think of good debt, it's the mortgage that we use to buy our rental properties. Now, good debt allows us to reduce our taxable income, which is where you generate either tax refunds or reduce your overall tax bill. Now, I want to dive into more so kind of a high level version of how cash stemming actually works as a strategy. And it starts with two fundamental components and really understanding kind of why these two components are needed and how they play in to executing the strategy itself. So the first thing is this is designed for homeowners. We do have to own our own home. And obviously there needs to be that bucket of bad debt. So we need a mortgage balance on that home. Now, it doesn't have to be your primary residence, for example. It could be a cottage that you own. As long as there's a bucket of bad debt, a loan that we are not able to deduct the interest expense off of, we can structure that correctly to start executing the strategy. The second component of this is a source of rental income. All right. And there's a few different sources of rental income that we can capture. The most common is when you own a standalone rental property, like your single family detached home or a condo, right? Now, this does also work if you, let's say, have a basement apartment in your primary residence, in your home. That would count as a source of rental income. If you live in a duplex or a triplex, you're renting out several of the units, perfect. And more recently as well, if you have a laneway suite or a garden suite, we can also consider using that. Now, two kind of major considerations. This does not work if the rental source, so the rental property, is owned within a corporation. All right, there's tons of other benefits and reasons why you would invest within a corporation, but to leverage the rental income for this particular strategy, the rental income source has to be in your personal names. And the one other piece is Airbnb properties, which is something we get asked about a lot. Given the changing regulations with those properties and the income itself, the typical recommendation is not use properties that are being Airbnb'd for that source of rental income.
And why is that? Is that because there's a potential commercial aspect to it?
No, not necessarily the commercial aspect to it. It's the changing regulations on Airbnb's property around. So a few things. Obviously, they've got now the HST rules have come into play. There's a risk that they could remove all tax benefits from borrowing for Airbnb. There's just too many changing regulations around it. Yep. That makes it hard to be super confident to know that the strategy that has been in play for 45 years is going to still be allowed. So it's going to be a lot of work to set things up to maybe not be able to see the benefits like we can expect.
So it could be done, just not recommended because it could be complicated.
That's right. It could be complicated. You may go through a bunch of work to effectively have things, no longer used. There's also a lot of consideration around too, which many investors who have Airbnb properties, if you're living in it or using it for any personal reason, it muddies the water on deductibility of debts or deductibility of interest. So yeah, the typical recommendation is avoid it. Now, we're going to walk through kind of an example client. We use Billy here as our case study. So Billy, like many Canadians, like myself, he owns his home and he owns a rental property, right? And he goes to work and he's going to use his salary to cover the mortgage expenses on his primary residence. And he's hopeful that the rental income is going to cover, all the mortgage payments and other expenses for his rental property, right? And after 30 years, Billy will end up having fully paid off his mortgage on both properties. He's left with 2 free and clear homes and a source of rental income generating him money. Like, we all agree, this is great. We know that there are tons of benefits to this. What cash stemming allows us to do is really accelerate and complement what is already a good strategy by maximizing some of the additional values through that debt conversion. Now, there's 2 steps when we're implementing this. And again, these are very simplified versions just for the purposes of kind of an understanding and an illustration. The first change we're doing to Billy's mortgage is we're restructuring the mortgage on his primary residence, and we need it into something called a readvanceable mortgage product. Okay. Now, a readvanceable mortgage product in and of itself is at a minimum 2 components, a mortgage plus a line of credit. And what's really important about it is the fact that the mortgage and the line of credit interact with each other. So as we pay down the mortgage, we get access to more and more borrowing room within our line of credit. All right, that functionality is super critical when we're implementing this type of strategy. Now, the second change we're making for Billy is actually a cash flow change. So your rental income is still going to come in generated by your rental property every month. And along with your regular mortgage payments that we're still going to be making out of pocket, we're going to use the rental income to make an additional prepayment on the mortgage on our home, or that bucket of bad debts. We're going to reduce that bad debt with our normal payment and that additional payment using our rental income. Obviously begs the question of then, well, how are we covering all of the expenses for our rental property? And that's where the line of credit comes in. So we're going to borrow from the line of credit to cover all of those rental property expenses. Now, it's really important to understand that we're not, in theory, taking on more debt because we're reducing the primary residence mortgage with that rental income in addition to our normal payments. So unless you're maintaining a very large cash flow negative property, you're actually maintaining the same debt levels over time. Now, obviously, as the line of credit balance grows, there's going to be a minimum interest payment. And because of that readvanceable nature of the product, the interest is going to be able to be capitalized to the line of credit itself, meaning that the line of credit is simply just adding the interest cost to that balance over time. So from a cash flow perspective, you're not actually making any material changes to your standard cash flow as you're probably already experiencing it today. Now, going back to the idea of good debt, bad debt, how does this strategy actually generate income tax refunds? Or how does this even have any relation to income taxes at all? And it goes back to the idea that the CRA treats our debt differently, depending on why we're borrowing the money. So in this particular case, because we're using the rental income to pay down the mortgage on our home faster, in addition to our regular payments, and then we're going to be borrowing from our line of credit, effectively converting the nature of the debt towards a qualified income generating asset, i.e. a rental property. The balance that we're accumulating on our line of credit is now accumulating interest, and that interest is what's allowing us to reduce our taxable income as with that interest expense. And when we're reducing our taxable income, we're either going to be generating income tax refunds or lowering our tax bill, depending on the nature of how we file our personal income. Now, with cash damming, the way the strategy is originally designed is we then take those income tax refunds we're receiving every year to pay down the mortgage on our home, to pay down that bucket of bad debt every single year, even faster, helping us get out of debt as quickly as possible, out of bad debt as quickly as possible. And I'll recap this one more time for you. Again, this is just the very simplified version of kind of this cash flow change. So that second change that we do when we're implementing cash damming with clients, we take the rental income and alongside our normal mortgage payments that we're still going to be making out of pocket, right? We are hammering down that bad debt bucket, but we obviously still need to capture and pay all of the rental property expenses. So we're going to re-borrow the amount that we need to cover those expenses from our line of credit on that readvanceable product. And the interest expense that accumulates over the year on that line of credit gets added as an expense on our income tax returns, reducing our gross taxable income, generating us those income tax refunds or lowering our tax bill, which allows us to make that additional prepayment on our bad debt mortgage every single year. Now, if we go back to these folks, my wife and I, and we didn't call my son Devon. I lost that battle. We actually implement the strategy ourselves. So when we're talking to clients and when we're talking about this, these are real life strategies that are being implemented by ourselves. And I'm going to share with you our particular benefits as we have them set up right now. So We have about 25 years left on our mortgage, and leveraging this strategy is going to generate us about $211,000 of income tax refunds over the lifetime of that mortgage. Now, because we're getting those tax refunds, we get to shave about 4.92 or 5 years off our mortgage, which saves us an equivalent of $143,000 of mortgage interest over that time frame. Now, because we've got the CRA helping us pay our mortgage down faster, shaving interest off our plate of expenses, we're going to have 5 years of extra free cash flow that we're going to be able to invest. And the way the numbers are calculated is assuming a 5% return on those payments if we're investing them on a monthly basis throughout those 5 years. What would my portfolio look like? And I'd be left with about $331,000 of cash. I can obviously deploy that cash in any which way, shape, or form I'd like. And there's tons of other ways to maximize results, i.e. if you wanted to invest the tax refunds rather than pay down debt, all perfectly acceptable. But for myself, we're looking to do this particular strategy to try and get us out of that primary residence, out of that bad debt bucket as quickly as possible. So we're about a $686,000 total improvement. A dollar earned is as good as a dollar saved, especially with how much we have to earn to walk away with after-tax dollars in Canada.
Yeah, and I just want to quickly touch on the investment portfolio thing and kind of simplify it a little bit. Essentially, you're not making mortgage payments for 5 years. So take what you would have been paying towards the mortgage and put it into an index fund. And at a nominal 5% of your interest, that's what Devon would have accumulated after 5 years. So you're just continuing to make your mortgage payments, but it's going into an investment. Yeah,
exactly. Now, Ryan, we did connect last week and kind of chatted through what your particular scenario would look like. And now we know that, and I think you've shared this with probably most people most of your clients and people on this call, that you do invest through a holding company. So what we've done is when we were chatting last week, we took 3 of your existing rental properties and recreated them as though you own them in your personal name. And between your home and your cottage, we've got obviously a lot of opportunity to convert your debt to build in some material benefits. So by taking those theoretical 3 rental properties that you'd go out and purchase, exact same numbers, your net results would look roughly like this, which is converting all of your personal debt, all of your bad debt, into good debt over time. So by doing this, with no difference to your kind of regular cash flow scenarios, assuming those 3 properties, we'd be shaving about 7.5 years off a 30-year mortgage for you, generating $585,000 of approximate tax refunds. And that 7.5 years of mortgage time saved is equal to about $637,000 of mortgage interest. And as Sean just mentioned, that this investment portfolio for over that 7.5 years assumes that you would, continue to make your mortgage payments, and I put that into, air quotations, by paying yourself, meaning monthly deposits into an index fund at an average rate of 5% return. You'd be walking away at the end of your 30 years with a net portfolio value of $1.53 million.
That's wild.
Yeah.
So cumulative savings by taking a tax damning strategy versus my current strategy and most people's would be nearly a $3 million net difference.
Well, it can be complementary, right? Like there's so many advantages to investing within a corporation, right? Like there are tons. A lot of times debt doesn't get registered on personal bureaus. You've got tax sheltered ways of generating income. You have additional abilities to leverage within the corporation for other types of finance. Like there are so many different good benefits of that. So it's not necessarily to say that that's in any way the wrong way to do it. This is simply something that can be complementary if you choose to invest for maybe 1, 2, or 3 properties outside of your corporation to also take advantage of some of these benefits.
Which I can. I mean, I invest through holding corps for that strategy. Like, the liability, tax savings, all that is important, but mainly the fact that it increases my borrowing ability so drastically, it makes so much sense for me. But I really only have 1 property under my name. When I walk into a bank and I pull a credit report for a new mortgage, there's 1 property under my name. That's probably my primary. But I probably have the capacity for 4 or 5 and still to be able to get financing on through my company. So this is definitely something I'm going to consider and will do for my future properties.
Yeah, awesome. So, as amazing as the results can be, I I'm very conscious about making everybody aware of any sort of risks related to implementing any strategies. And for anybody who's familiar with the Smith maneuver and another debt conversion strategies, they know that they've been in place since the late 70s, early 80s. They've been tried, they've been tested, and they do pass, right? But the one thing that the CRA hates doing is handing out tax refunds. And if it's implemented incorrectly, this is where we run into problems. So we typically see, and I know a lot of people in the past have had issues because they just don't follow the rules as they're outlined by the CRA for how we go about tracking and structuring this stuff correctly. And that's not anybody's fault. The biggest issue is the fact that there are, very difficult financial regulations. A lot of these things are not written in plain English. They're written in, finance jargon, and it's not necessarily the easiest for us to be able to, stand there and try and implement them ourselves, and also make sure that we're maximizing the right tools to help us understand what those benefits could be. Now, the reason you hear about these strategies from a mortgage broker rather than really anybody else is we're in a relatively unique position to be able to help clients and people implement this strategy, because a lot of it hinges on the right bank, the right product, and the right mortgage structure. The cash flow scenario and guiding with that's something that we can absolutely help with, and there are ways of doing this, but the right structure, the right bank, the functionality of implementing this is what's so critical, along with really intricate tracking of how we're setting this up. That's really kind of the secret sauce. So Sean and I do this. We do take on clients specifically for the purposes of helping them implement cash damming. And when we do that, we provide them a personalized plan based on their independent results, right? We've got calculators that we built to help us understand exactly whether or not this is something that is worthwhile for you. We're not doing this for you unless it's absolutely worth your time. What we do find most of the time is it absolutely is. Now, something we do, and this is more so me being a relatively cautious and kind of risk adverse person, is I also want to make sure that you guys are being supported with every single aspect of expertise. So we've partnered, or we have an in-house partner CPA, chartered professional accountant, who comes and reviews everybody's specific plan to make sure that we're implementing this for you guys as flawlessly as we possibly can. And we do then stick with you for 6 to 12 months as you change your cash flow to make sure that you're doing everything correctly. Now, for anybody who has worked with a mortgage broker in the past, they know typically, we're not charging fees unless the lender isn't paying us for something in particular. But for this service, we do charge. It's a fully tax deductible consulting fee. It starts anywhere from $5,000, depending on the complexity of the setup. And I'll leave you with this before we open it up to questions. If you're ever wanting to talk to a family, friends, your accountant, here's some quick points to help you really summarize what this is. It's a proven mortgage tax strategy. It's been in play for over 40 years with the right mortgage structure and line of credit on your home and that source of rental income. Right? We're going to convert all of our bad debt to good debt, resulting in income tax refunds over the lifetime of our mortgage, which we can use for any number of reasons, but the strategy itself is designed then to take those tax refunds, pay down our bucket of bad debt even faster, get us to that freedom point, and open up other options.
So we're going to put in the chat these two links so that we can get off the screen share. And
awesome.
Yeah.
That's really cool. I mean, it's a lot of information to take in, and that, so you're going to put a link to the course in the chat group?
Yeah, so it's going to be a landing page. You just fill out your name, your email. We're not going to spam you or anything, and it'll take you directly to another page, which will have the summary document you can click on, which will cover everything. And then the 15-minute course, which we just launched today. It's essentially this webinar, just edited nicely, and you can just watch as many times as you want. Yeah,
I took your previous course, which was a bit longer, but
yeah,
I mean, it really, really helped. Guys, that was awesome. I mean, the savings is significant, and I think the fact that you guys have been setting up the structure now for some time is very telling. I think we do have a few answers. Guys, if you want us to answer any of your questions, just put it in the chat group in the comments, and we'll be happy to answer them. We've got a question from Irene. How would an in-house suite duplex work where everything is in one mortgage? So I guess I think Irene's probably asking, she probably lives in one unit, and maybe she's renting the other one out.
Yeah. So that really comes down to why I was stressing the right kind of mortgage structure and how we do this. So the right way to set that up would actually be to split the mortgage into two different mortgage components. And you do that, one for the suite that you're living in, that's your primary residence. And then you have one that's actually attributed to the rental portion of your home. And actually, and your accountant might be doing this for you already behind the scenes, but they certainly appreciate you splitting the mortgage into two, because it makes it super nice and easy for them to see what interest expense is attributed to what unit. But it's that specific division where you're already able to write off a portion of that interest that gives you the primary residence and rental property, those two components that we need to allow us to manage the conversion of what, the balance that's left for your primary residence. So it's absolutely possible. You kind of treat it as though it's a standalone rental property. So you divide the mortgage into two and execute the strategy that way. Cool. There's a lot of complexity to that though. So I just want to add, it's got to be done very specifically in relation to size of units, how it attributes to your home. So that's one that, you definitely need some guidance on. So feel free to schedule a call. I can talk you through that in further detail.
Great. Someone's asking, Carla, hello, can strategy be used for stock investments instead of rental property?
So the stock investments, meaning the stock investments pay a dividend. The dividend is a prepayment on your mortgage to then re-borrow to invest in additional dividends. Is that
the Smith maneuver?
Is that the idea? Yeah.
It sounds like the Smith maneuver. So Carla, do you want to talk about the Smith maneuver? It's an interesting thing that I read about years ago, and I think you can help people with that as well. Cash damage just takes it to the next level, right?
Yeah, exactly. So the Smith maneuver, and I've spoken several times with Robinson Smith, who's the son of Fraser Smith, the guy who came up with the strategy. Yeah. We have a big community of professionals who are really diving into these strategies to make sure we're implementing them the right way. So the Smith maneuver is a phenomenal strategy. So the founding strategy of this particular concept, right, is that we have an opportunity in Canada to take what is our largest expense, usually the mortgage on our home, and turn it into a tax-deductible investment loan over time. Now, the Smith maneuver, this plain Jane Smith maneuver, does that by re-advancing every mortgage pay down, every mortgage principal payment we make, and investing that into an income-generating asset like a dividend-paying stock. Okay, and because we're doing that, we're now borrowing to invest. We generate income tax refunds, and we use that to pay down the mortgage on our home or that bucket of bad debt even faster. Now, the Smith maneuver's goal is really designed to kind of keep us in debt long term. But the idea is that the faster we leverage the equity pay down in our home to invest, the faster we get to, or the better the longer time horizon is for those investments to outperform the cost of that debt. And that provides us with tons of additional opportunities. Cash damming in and of itself is designed based on the rental income properties because it's consistent income that comes in, and there are expenses related to that rental property rather than investing in the stock market. What you can do, and I'll share this because this is actually what I do. I complement the two strategies and I combine them. So I'm busy converting my debt with cash damming, but any additional pay down of principal that I'm making on my primary residence that isn't re-advanced to cover my rental property gets invested into the market. So I am leveraging my home equity that way. And I'm also leveraging my rental property's equity in that same way. So every month where my rental property is getting paid down with my line of credit, I'm also opening up more borrowing room within, or more equity within my rental property that I'm advancing into the mortgage or into the financial markets as well. So you can really stack strategies to help you build and accelerate things beyond even just what we showed you today.
Yeah, when you see the numbers over a period of time, this is really powerful stuff. We've got a bunch more questions from Monica. What if the primary mortgage has been paid off already, but carrying mortgage but she has also a second mortgage for a rental property?
Yeah. So if you've got a mortgage for a rental property, it's already going to be tax deductible, right? So you're already receiving kind of the maximum benefit. So this strategy is for those who have a bucket of debt that we're not able to deduct the interest off, because that's a cost that you are going to have to pay, and we can build efficiency into it. If you're already out of debt, bad debt in the sense of a non-deductible loan, fantastic. You don't need this particular strategy. There's tons of other things you can do though, whether it's just leveraging the equity in your home to invest and leverage things that way.
Yeah. So Monica, congrats. You have good debt. That means you're using that. It's a tax deduction already, but you're also using it to make money, which I love. All right, Kenny, Kim, how is the plan affected by the about 2% higher interest rate for HELOC than the typical home mortgage rate? That's a good question.
Yeah, it is a good question. So right now, line of credit rates are typically around prime. Prime's at 5.95 today. The next Bank of Canada cut or meeting is December 11th. So with most mortgage rates between kind of 4 and 5%, depending on the term, there is that kind of delta. Now, that's not always the case. And what you really want to be looking at is that net effective rate of the line of credit. So the line of credit is tax deductible because it's borrowed for the purposes of investment. Your mortgage is not. So your mortgage, if you're paying 5%, for example, that's what you're paying. A deductible or an interest deduction on a loan reduces the interest cost based on your marginal tax bracket. So if you're at a 50% marginal tax bracket and your interest cost is 6%, well, your net effective cost is 3%. So it's actually a cheaper way to maximize or to leverage money borrowing to invest because that net effective interest cost is lower. The other reality too is that line of credit rates aren't always more expensive than mortgage rates. So as that prime rate moves up and down, sometimes it'll be cheaper, sometimes it'll be more expensive. And typically what we do, and this is really important to understand, we're converting the nature of our mortgage debt over a certain period of time. It doesn't take 20 years to do that. For my particular scenario, I'm only converting my whole mortgage balance to this tax deductible loan over 8 years.
So your principal residence mortgage will be completely paid off, but the line
Correct.
of credit will be
the line of credit balance is now, whatever was remaining because of this conversion. So my line of credit can be structured in any particular way. I can take that balance and lock it into a different mortgage component. That mortgage is still tax deductible because it's based on the purpose of borrowing rather than how it's set up. We use the line of credit to manage this re-advancing because you can't pull $2,500 from a mortgage every single month to cover that expense. So the line of credit is more sort of functionality needed. There are tons of strategies we can use to reduce that interest cost over time.
Great. I have 3 doors in a bungalow, $400K principal. You might want to write this down. Value $1.4 million. Rental income of $6,000. Cash flowing about $2K a month. What would be my strategy here? I'm locked in at 1.92 till November 2025. That's a great rate.
Yeah, that is a great rate. So I'd have a few follow-up questions on that. Are they separate units within that property? Like a bungalow, has the bungalow been split into 3 fully separate units? It can't just be doors that you're renting out, meaning like rooms, but they're fully separate units. Then great, absolutely. They don't actually have to be legal to implement this particular strategy, but they do have to be fully separate units. So kitchen, bathroom, bedroom, living space, that fun stuff.
Let's assume they're separate. I don't know if he's going to get back to me, but let's just assume 3 separate doors, probably 3 separate units.
Yeah, so it works very similarly to, now assuming you're occupying one of the units and renting out the other 2, then absolutely you would divide it into 3 mortgage components, right? 1 for each of the rental units and then 1 for the unit you're in. You'd have to figure out how much of the mortgage is related to those 3 units, and then you can convert whatever mortgage balance is attributed to your personal unit, leveraging the rental income that's being generated. So absolutely same type of option. You just want to figure out exactly what those numbers are.
But also it's important to figure out, like a lot of these people who still have really low rates are waiting till renewal to execute the strategy. So we'll get on a call now and we can forecast what the strategy will look like come renewal. We can get all the plan built and everything ready so that come renewal, they can start executing it.
Yeah, exactly.
Yeah, makes sense. Can this strategy be used with a rental property that is held in trust?
Mm-hmm.
Good question.
Yeah. So I'd have to look into the legalities of and the structure of the trust itself. It's probably who the actual owner is. So if the trust, like I know the trust owns the property, yeah, it's going to be specific to the trust almost certainly. And it's good. Yeah. Like it's a complicated question. We'd have to get accountants involved to figure out what the legal structure of that trust is, who the beneficial owner is, to see if it's possible.
Yeah, feel free to book a call with us. We can kind of navigate how to ask that question with your team.
Yeah, that's the links you provided. Are those links for them to reach out and connect with you guys as well, or is it just the course?
Yeah, so one of them should have been a link to book a call. You can also go to freedom10.ca. It has the course, it has the booking. We kind of just put it.
Can you share that, Sean, in the chat? That'd be great.
Yeah.
Freedom. Cool. So we've got Raheem. Hello. Can the primary residence HELOC be used for other personal use?
Oh, okay. So this is a really good question. This is what normally kills a lot of people's benefits because they do this. It's called commingling debt. So if you're borrowing from your line of credit, it has to be explicitly for the purposes of investing. All right. The minute you start to add personal debt into that same bucket, it's commingled. The CRA doesn't do a lot of work. They don't want to help determine what is what. They want very clean tracked expenses for stuff like this. So absolutely not. Do not borrow from the line of credit for personal use. Now, this is where, again, we provide expertise to clients because there are lenders that can have multiple line of credit components within these readvanceable products. So we can help carve out a piece that you can use for personal purposes. Again, like really specific individual requirements that can help you avoid some of the most common mistakes. That is probably number one.
Yeah. And like the biggest benefit of kind of working with us is 6 months of helping you set this up, helping you track it each month, making sure that everything's cohesive with your accountant. It's not as easy as the diagram we just had, which is like super simplified, yeah. But we simplify it so that people can comprehend it, but you really want to make sure you're working with the right people, because like one wrong thing in Revenue Canada is clawing it all back.
Well, let's talk about that. What is the process for people to get started with this?
So pretty easy process. I mean, first thing we do is an introductory call, kind of like a normal mortgage process would look, right? We want to get connected with you. We want to understand what your individual scenario is. And then typically we send you a data collection sheet where you're going to provide us some of the numbers that we need to actually take them away and run the calculations. Yeah. And more often than not, we're helping people structure the mortgage. So we're also sending you your mortgage application. Once we've got that mortgage application, we know it's possible. We know that the results are good and they make sense. That's when we're actually then working and starting to move ahead with the implementation, getting that mortgage approved, structured correctly, and helping you get ready for implementing the cash flow process itself. That doesn't obviously start until we're closed on the mortgages and ready to go, and then we're with you for 6 months from there. So like relatively straightforward process and not unusual compared to a normal mortgage application process like people would be used to.
Yeah. And what does the 6 months look like?
So 6 months, it's really up to you. I offer to connect on a Zoom call every single month when clients are moving the money around to support them through that. They're also getting a documented plan which details exactly what they're doing on a monthly basis. And again, normally a part of the mortgage setup, we're working with them to help them get bank accounts set up, labeled, pre-authorized debit set up to the right accounts. A lot of this stuff is guidance that we provide on how to do it, what to do, and it is lender specific. Every bank has a different process for stuff like that as well.
I just had a question coming from Todd Smith. I was going to let you guys go. I appreciate your time, but let's get one last question in. So I have put money down on 3 pre-con condos. So he's invested in 3. I have no other rental properties right now. I have cash reserves invested to make down payment. Occupancy is in 2027, 2028. I need to structure my mortgage on the primary residence with HELOC ahead of time. Question, should I use cash reserves to pay down primary mortgage, then use the HELOC for down payments on the condo?
Great question. Yeah, there's going to be a lot of benefit to doing it that way. That's what you would call the debt swap. We do a lot of that for clients at renewal as well. So what you're suggesting, Todd, is really intelligent. You're going to take cash, reduce a bucket of bad debt that you're not currently able to reduce any interest expense off of, and effectively, instead of using the cash to make the down payments, you're going to reduce your bucket of bad debt and reborrow some good debt. So same net debt at the end of the process for you, but now a good portion of that will be tax deductible against each of those rental property assets. So yeah, fantastic idea. And then what you can do is complement that even further by leveraging the rental income sources you're going to have to convert the rest of the debt.
Yeah, great question.
Just before we go to the next question, I want to touch on when people are setting up this strategy, whether they do it with us or anyone else, there's only 7 banks or mortgage companies in Canada do it, but one of them, and which is one of the biggest banks, has horrible prepayment privileges. And there's one other thing wrong with it. So you really want to know which bank to work with and which one not to work with, because you can go in and set this up. Like, I'm going to set up a line of credit. I'm going to start borrowing from it. But then you come to being able to actually execute it and you can't. So work with the right people.
Yes.
Yeah. Well, I mean, that's always the case when things are, it's not complicated, right? It's a simple kind of concept, but there's steps, and it's better always to work with someone who's been able to do it for themselves and have been able to do it successfully. We got another question from Ramat hello, if the rental property has a HELOC, can it be maxed out and continuously kept maxed out to pay down the primary residence mortgage? Also, can the rental property be refinanced to do a lump sum payment on the primary?
This is my favorite question. No, don't do that. Please don't do that. That is so. And the reason we don't do that is it comes back to the nature of why we're borrowing the money. All right. That is kind of the crux of everything that we're doing. So when you're borrowing money from a rental property, it's great. You're borrowing against the secured asset, but the CRA is going to care about what you do with the money, not where you're borrowing it from. So if you're borrowing it from a rental property, but paying off debt that is non-tax deductible, your personal debt, the money that you've just moved the debt from one property to the next. You haven't changed the nature of the debt for tax purposes. So that's what you can't just use a line of credit from any property to pay down personal debt and all of a sudden it's tax deductible. It's a very specific process that needs to be kind of worked in the right way to change the nature of the debt for tax purposes. And that's what's so critical about the strategy.
Awesome. That was great, guys. Very good information. I think anyone listening to this, check out the Smith Maneuver. I remember when I read the book, I think it's called The Smith Maneuver, probably about 10 years ago. It allowed me to buy a new car in a very strategic way that allowed me to write off the car. And essentially is a very simple concept that allows you to turn bad debt into good debt. And then this is pretty much it on steroids.
Yeah.
So
yeah, pretty much. And if people want, I do have links to stuff where they can buy the book. As I mentioned, I'm pretty well connected with the Smith Maneuver group and things like that. So yeah, if people want, feel free to reach out. I think I have some copies of books at home. Be happy to share them.
There's one more question.
Yeah, let's answer this. I have a basement rental in my property where I'm living. What is the process? How can they get this set up so they can start saving money and pay down their mortgage sooner?
Book a call.
Yeah, book a call. We'll help you divide the mortgage into the right components to allow you to start to leverage this. And then we'll guide you through the cash flow movement to make sure that you're converting the bucket of non-tax deductible debt over time.
Yeah. And all these calls, the first calls are usually complimentary. We don't charge. We just want to make
so
sure it works for you and the numbers look good. And then from there, we can move forward if you want.
Yeah.
Right. So if you're going to save someone money, you're going to charge them the fee in order to do it.
Yeah,
exactly. That's awesome. Guys, that was awesome. I appreciate that. I learned a lot. Hopefully everyone else learned a lot. And hopefully you guys take the course. It's a really informative thing and appreciate your guys' time.
Awesome.
Thanks, guys.
Thanks for
having
having us.
Take care.
Good night.
Good night.